Hello, I'm Andrew Kern with Clelan and Company. A lot of our clients are approaching retirement or in retirement. Some are taking distributions from their IRAs because they have to. Others are taking them because they want to. Some clients have inherited IRAs in the last few years, and some are charitably inclined. All are faced with new changing legislation, including the 2019 Secure Act, and could soon be introduced to a new Secure 2.0 Act, which currently has bipartisan support. Surprisingly enough. And markets continue to face volatility, which is increasing investor angst. You're forced to make a lot of important decisions, and to align those decisions with a changing legislative landscape in volatile markets. So as a result, we wanted to share some strategies that are growing in popularity with clients. First, Qualified Charitable Distributions, or QCD for short. So some questions to answer. Are you writing checks to charities from your checkbook? Since Trump's Tax Cut and Jobs Act, are you now taking the standard deduction instead of itemizing on your tax return? Are you age 72 years or older? If you answered yes to these questions, then you may benefit from donating all or a piece of your required minimum distributions to a charity rather than donating from your checkbook. It's possible you don't get to deduct the amount of the checks you write to a charity. So a QCD, when executed properly, would result in what would otherwise be taxable income, never hitting your tax return. It's been a fantastic way to help clients fulfill their philanthropic wishes while reducing their potential tax burden. The second is Roth conversions. Some question to answer. Are you approaching retirement with a lower income than you were during your peak earning years? Are you retired but not yet taking RMDs? Have you identified an excess amount of wealth in your financial plan? Do you have other humans, meaning not charities, as beneficiaries of your IRAs? If you answered yes to some of these questions, then Roth conversions may be a strategy worth considering. As a result of the Secure Act, inherited IRAs can no longer be stretched out over the beneficiary's lifetime. They must be distributed or taxed within 10 years of the date of death. So for sizable IRAs, this can result in a much higher tax burden than if it were stretched out over a longer period. Oh, and it's also possible that your beneficiary, which oftentimes is your child, could be in the prime of their earning years when they inherit those funds. Hence, they'll be at an even higher tax bracket when they must take the distributions. We're having lots of legacy conversations with clients, and we have yet to have a client purposefully list the IRS as a beneficiary to their wealth. Quite the opposite, actually. Most would prefer to disinherit the IRS in a legal way, of course. These legacy conversations also uncover a desire to provide an increasing tax-free legacy to your loved ones. Roth conversions can be a strategy to help accomplish just that. The third are beneficiary designations themselves. Do you want to leave your money to a charity, a church, or an alumni? Are you leaving them a taxable asset or a tax-free asset? You may not know how to answer that, but I'll briefly explain. Traditional IRAs are taxable assets from a federal income standpoint to the recipient. Your checking accounts and personal property are not. So a non-qualified account, individual, a joint brokerage account, these are also not taxable assets, as they would receive a step-up in basis, at least under current legislation. So why are we leaving a tax-free asset, meaning cash in our state, to an entity, meaning your favorite charity, that doesn't pay taxes, while simultaneously giving your child, who must pay taxes, our taxable IRA assets? Perhaps it would be worth exploring leaving a taxable asset to the tax-free charity and your tax-free assets to your tax-paying children. This is just another example on how proper planning can maximize your legacy in a tax-efficient manner. Attached are a few articles and charts that explain these in more detail, including some of the finer nuances of each. And as always, it's our purpose and our passion to help you build your financial success. If you ever need anything, we are here for you, so please don't hesitate to reach out to our office. Thanks for watching, and have a great rest of your day.